Good evening. Thank you, Skip, for that very kind introduction, and I'd like to thank the Clinton School for inviting me. It's really great to be here. I have not been in Little Rock in a number of years, but I have been here several times previously. I've got some great friends here, and Skip mentioned Governor Jim Guy Tucker and his wife Betty are here, and I'm so honored you're here. As I have become good friends with you over the years. Another very fine public servant, Judge, federal bankruptcy judge Audrey Evans, and her husband Don. So it's really great to be here. As Skip mentioned, I oversee the Troubled Asset Relief Program, or TARP, and that really means I've had the honor of overseeing one of the most unpopular programs probably in government recent memory. I recall not long after I joined Treasury, I joined in the spring of 2009 when the financial crisis was still quite severe. There was a poll that came out that said TARP, the word TARP was less popular than the word Guantanamo. So, you know, we all kind of looked at that and said, well, yeah, all right, we got our work cut out for us. But while TARP may be unpopular, I'm here to persuade you that TARP was one of the most effective government programs in recent memory, and it was also one of the most necessary. And I would say TARP is a perfect example of the values that President Clinton wanted this school and his library to embody. He said that he wanted people of all political persuasions, especially young people, to see that public service is noble and important, and that the choices and decisions that leaders make affect the lives of millions of Americans and people across the world. Next week marks the 5-year anniversary of the law that created TARP. It was called the Emergency Economic Stabilization Act. So it's a good time to review the record of TARP. And even though there's still lingering damage and pain from this terrible recession, as a result of the actions that were taken through TARP, as well as a number of other measures, the financial panic was stopped. The financial system did not collapse, and the economy is growing again. And although growth is not as robust as we would like, we are in a much better place than we would have been without TARP. So I want to talk about 3 things. The first is, why was TARP necessary? Now, maybe because you're here, you know why it's necessary. Maybe because you're here, you thought it was totally unnecessary. I'm not sure, but we'll find out. Second is, what did it do? And the third is, what should its legacy be? So first, why was TARP necessary? Let's look back on when TARP was created. As I said, I wasn't in government when the crisis began. I was practicing law in New York, but during the events of September 2008, I don't know where you were, but I remember being quite concerned. People around me were quite panicked. And I was also reminded of the stories I heard as a child, and maybe this is familiar to some of you. I was born not far from here in Louisiana, actually, and my parents grew up during the Great Depression. And they were the children of poor immigrants who settled in Oklahoma and Kansas. And I recall hearing stories all the time I was a kid from my parents and grandparents about how hard life was during the Depression. Of course, some of those, you know, rolled off our backs, but, you know, it's a terrible thing. We thought, oh, it couldn't have been that bad. But you know, over time we realized, no, it really was. And the experience of growing up during the Great Depression fundamentally shaped their perspective and their values for the rest of their lives. And they never forgot the tragedy of that period, and nor should any of us. And I think that issue of memory when it comes to a financial crisis is very important. Now, anyone who lost their job or lost their home or their savings during this recession doesn't need a reminder that this was a terrible crisis. But, you know, the idea that our financial system almost collapsed, that we almost fell into another Great Depression, is not easy to comprehend. What would that have really meant for day-to-day life? Now, fortunately, we didn't find out. The worst did not happen. But we were that close. So just to remind you maybe of how it felt, we've got a few headlines that we'll show as I talk. In September of 2008, our nation was in the worst financial crisis since the 1930s. These are just a few of the headlines. Several major financial institutions had already failed, including Bear Stearns, IndyMac, Washington Mutual. Fannie and Freddie had been taken over by the government. On September 15th, Lehman Brothers filed for bankruptcy, and a lot of people remember that as the real flashpoint. And the next day, a money market fund broke the buck, which meant that one of the investments that most people really think of as one of the safest things was no longer really considered safe. This triggered the start of a run on money market funds generally. People started withdrawing their money from money market funds. Institutions, big corporations were withdrawing their money. The day after that, AIG, one of the largest and most complex financial firms in the world, was on the verge of failure. Confidence in the financial system was vanishing. Panic was spreading. The stock market dropped by more than 770 points in a single day. And the financial wildfire was quickly spreading far beyond Wall Street. The credit markets that provide financing for your credit card, for your auto loan, for your student loan, for mortgage loans, for small business loans, those had basically stopped functioning. And so for the first time in generations, Americans were actually starting to question the safety of their money in banks. And for the first time in more than 80 years, we actually faced the very real possibility of a run on the nation's financial system. Now, only this time it would not have been like that scene from It's a Wonderful Life. You might remember the movie. It's a great movie with Jimmy Stewart. So, you know, all the farmers go into town. They line up outside the local bank to withdraw their money. And Jimmy Stewart, George Bailey, that is, holds them off. You know, he kind of manages to do this great explanation of how the financial system works in very concrete terms that causes people, okay, you know, we'll wait. But it wouldn't have happened that way, right, this time. You wouldn't have had to drive to your bank. Who drives to their bank much anymore? It's all could have happened at the speed of a mouse click, and basically all at once. The crisis was causing our economy to collapse. By the time President Obama took office, we were losing almost 800,000 jobs a month. Our economy wasn't a question of growing slowly. It was shrinking at a rate of 8% a year. Between December 2007 and December 2008, household wealth fell by almost 20%. That was more than 5 times the decline in 1929. So in September 2008, the government had limited options. The Federal Reserve and Treasury were taking whatever actions they could under existing law, but they could not get ahead of the crisis nor contain the damage. They did not have sufficient tools to do that. Our nation was literally on the edge of falling into a second Great Depression, and that is why TARP was necessary. So let me come to my second topic then. So what did TARP do? Well, its purpose was to restore stability to the nation's financial system. Now, the financial system, you could think of it like the circulatory system for the nation's economy, right? It enables you to have a checking account or a savings account, to get your payroll deposit, to purchase a home, finance your children's education, save for retirement. For businesses, they get credit to grow and expand. It's a variety of things that we depend on the financial system, obviously, for. So you can kind of think of it this way. If you're in a serious accident, you cannot survive, much less heal, unless your circulatory system is functioning. And so it is with our economy. If the financial system stops functioning, well, that's a place of darkness we really don't want to go to. So TARP was part of a response to the financial crisis that was massive in scope. The response spanned both a Republican and a Democratic administration. It involved actions taken by the Federal Reserve, the Treasury, and other federal agencies. And here are some of the things that TARP did. So first, TARP stabilized the nation's banking system. Capital was invested in the nation's largest banks, as you probably know. But TARP also provided capital to banks of all sizes, including more than 650 small and community banks across the nation, including several here in Arkansas. I'm very pleased that Darren Williams, as Skip mentioned, the CEO of Southern, could be with us. We provided capital to his bank, and Darren and I spent some time touring some of the things that his bank is doing, along with some of the other small institutions that we funded in Mississippi. We funded Bank of the Ozarks, Regions, which is a mid-sized bank that I know is significant here. So if you think TARP was only about Wall Street, if you think TARP didn't help small banks, well, you could probably ask Darren. Ask the Mississippi bankers I spent some time with. The banks that took TARP funds held 98% of all the assets of all banks in this country. And that was important because the purpose was not to save any individual bank, but rather to save the financial system generally. Now, we didn't give the money away. We made investments so that taxpayers would receive a return as the banks recovered. Now, even after this, some people said, well, we're still not out of the woods. We should nationalize the major banks. You probably might remember that. Others said, as they had kind of said all along, no, we shouldn't do anything. We shouldn't have done this. We shouldn't do anything more. The problem will fix itself. The market will clear. Let the weak ones fail. Just go on. President Obama chose a different path. This was by the spring of 2009, or February, I guess, of 2009. And that was, we'd already provided some emergency capital, but we wanted to get the banking system to then raise private capital. How do you restore confidence so that investors will put money back into institutions? And so to do that, we required the big banks to go through stress tests where we would determine how much capital did they need, how much more capital did they need to withstand further adverse conditions, so that investors would know, so the world would know. We would publish all the results. Now, the government was prepared to provide additional capital, but we didn't need to, because once we had done that, people could see, okay, this is how much they need. That enabled the banks to go out and raise private capital, and that started the recapitalization of the system very quickly, something that, for example, Europe has been struggling with for years now. And that enabled us as a government to get out. We started at that point to exit these investments very quickly after they were made. Now today banks have far more capital than they did when the crisis hit. And we have almost completed our exit from all these investments. We hold investments in a few small banks that represent now less than 1% of the assets of the system. And I'll come back to where we are in the exit a little bit later. Secondly, TARP helped to restore the secondary credit markets. Now, in today's world, banks are really only part of the picture. We have what we call the shadow banking system. And we have large secondary markets that enable you to get a credit card or a loan to buy a car or a house. When you get that loan, you know, you might go to your auto dealer, get that loan. That loan is then repackaged and sold to other investors. Same is true with essentially your credit card receivables, your mortgage loan, student loans, small business loans. When the Obama administration took office, these markets had essentially frozen. They weren't working. And so we launched a series of programs to restart the flow of credit. How do we do that? Well, in one case, one of the major programs, we partnered with the shrewdest private capital managers we could find, right? And we put up government capital, and they raised private capital, and we went in 50-50 to get these markets restarted. Programs worked, and that recovery continues today. Now, credit is still somewhat constrained in this country. We're still coming out of this, but conditions are much better than before. Another thing TARP did was it prevented the collapse of AIG, American International Group. Now, Supporting AIG, I think, was one of the most difficult decisions made by the government. The outrage that it caused is understandable. Now, here is a company, the Treasury and the Federal Reserve provided a total of $182 billion in commitments to a single company. That's hard, it's hard to fathom that. So why did that happen? Well, by September of 2008, AIG had grown to become the largest insurance company in the world. At its peak, it had more than $1 trillion in assets. It provided conventional insurance to 75 million individual and corporate customers in 130 countries. But moreover, it had a substantial presence in a lot of other critical financial markets. It was a big investor in municipal bonds, corporate bonds, other markets. Now, unfortunately, it used the strength of its insurance subsidiaries, where its business was very good, to engage in some very risky derivatives transactions, which put the whole company at risk. And how AIG was able to do that without any federal agency being aware of the problem, well, that in and of itself is obviously the nub of the problem, but it's a larger discussion beyond the scope of my remarks tonight. But the simple fact is that AIG's sudden collapse would have accelerated dramatically the speed and intensified the severity of the crisis. The crisis would have likely spread to the entire insurance industry. The corporate and municipal bond markets and derivatives markets would have been destabilized much more. Investors would have pulled back even more from funding other major financial institutions, and that domino effect that we feared would have really kicked in. And so this all happens, you know, a day after the money market run, a day and a half after Lehman falls, and truthfully, the people who were in government responsible for this at the time, like former Secretary Paulson, Chairman Bernanke, they had basically a few hours, half a day maybe, to really decide this. AIG calls up and said, we think we need $40 billion today. So when you go home tonight, you know, and you're brushing your teeth, think about the window between this speech and brushing your teeth, and that's about how much time you would have had if you had been Hank Paulson to decide, do I commit $40 billion of taxpayer money, or do I take the risk that the financial system won't collapse? So the actions we took were designed to protect financial stability, protect our economy, and thereby protect all Americans. But, you know, still many people have questioned, well, did TARP really do enough for Main Street, for the middle class who bore the brunt of the recession? And the evidence of TARP's impact is not always apparent to many Americans. And that's in part because, you know, these TARP programs were about investments and institutions and markets. They're complex programs. They have weird acronyms. So they, you know, they're remote from most people's lives. And after all, for most Americans, particularly those who've known economic hardship the last few years, you know, if you ask them, well, when did the financial crisis really become severe? You know, they're not necessarily going to say, well, September 15th when Lehman Brothers went bankrupt, right? They're going to say, well, you know, it's when I got a pink slip, or when I got the notice that my home might be foreclosed on. And because we are still struggling with the damage from this crisis, I think a lot of people ask, well, you know, why didn't it help me more? And growth is too slow, unemployment is too high, and even for those working, median family income isn't rising. So we're not yet where we need to be. But what would have happened without TARP and the government's other emergency measures? Well, we can never say with certainty, but economists can make estimates. And there was a study by two economists in particular that I thought was very good. One who was a former advisor to Senator McCain, the Republican nominee for president in 2008, as well as another who served in the Clinton administration. So they covered, you know, the political spectrum. And they said that without TARP and the other rescue measures taken by the government, unemployment would have topped 16%. We would have lost an additional 8.5 million jobs on top of what we lost. We would have had much higher deficits. And the nation would have likely entered These are their words. A 1930s-like depression. Now, the fact that it could have been much, much, much worse, it may not be much comfort to those who are still struggling today, but it is the reality of what we have just been through. I also want to highlight two ways in which the impact of TARP on everyday Americans might be more apparent. One was our actions to protect the economy by stabilizing the American auto industry. The auto industry was in decline before the crisis, but the decline became a potential free fall in the late months of 2008. In 2008, the auto industry shed more than 400,000 jobs, and by December, the situation was really dire. With a deepening recession, the credit markets were frozen, Americans could not get auto loans, so auto sales were plummeting. And GM and Chrysler in particular were quickly running out of cash. Ford had kind of wisely seen that this might be coming and had basically stockpiled cash, as their CEO will acknowledge. There were no options for private financing. No bank was going to lend to GM. They tried. No bank was going to lend. So the government under TARP stepped in as the lender of last resort to prevent the collapse of GM and Chrysler. And we did that because of the devastating impact that that would have otherwise had on our economy, the collapse of those companies. The actions not only saved GM and Chrysler, right? We're talking about the whole auto supply chain, the suppliers that provide the parts, the dealers that sell the cars, the businesses that in turn help those companies. And even Ford's CEO has acknowledged, if the government had not stepped in, it's not clear what would have happened to Ford. Some experts have estimated that as many as 1 million jobs were saved as a result of the government's auto investments. And today, the auto industry has come roaring back. All three majors, GM, Chrysler, and Ford, they are all profitable. They're adding thousands of jobs. They are selling more cars. And Treasury is exiting its investments in the auto industry. We're almost done in that regard. Another way that TARP directly touched middle-class Americans has been by helping people keep their homes. Now, not since the 1930s have we seen a housing crisis on this scale. It was huge. Now, housing crisis has many causes. Buying a home has always required responsibility on everyone's part, so there's a lot of blame to go around here. In the years before the crisis, responsibility too often gave way to recklessness by lenders who sold loans to people who couldn't afford them, but also there were buyers who knew they couldn't afford them. But we had a massive societal problem, right? If your neighbor's house is foreclosed on, that's going to hurt the value of your property, and you start to, again, get this downward spiral. So what did we do? We tried to help responsible homeowners who really needed the help, number one, and who with government help could succeed, could stay in their home. It's been a very complex challenge, but as a result of the programs that we launched, millions more families have avoided foreclosure. And many families are spending a lot less each month on their mortgage payments. And the good news is that the housing market is now recovering, with home prices rising at their fastest pace in 7 years. So what about the cost of all these things that we did? Now, the true cost of the financial crisis, first of all, is not the cost of these programs, right? Again, if you've avoided a Great Depression, that's worth something. It's worth spending some money to do that. The true cost will always be measured in terms of the financial impact on Americans generally, the jobs lost, the thousands of small businesses that were closed, the homes that were lost to foreclosure, the retirements that people had to postpone, the college educations that couldn't be financed. And again, the most important measure of success is not, again, the profit and loss statement of the program, but whether the program helped to stop the crisis and contain the damage. But the fiscal cost of TARP is nevertheless something in which a lot of people are interested, with good reason. You should know. The answer may surprise you. So Congress authorized up to $700 billion for TARP. That's a number that most people, if they know any number, they associate with the program. And I think many people think, well, that money, I guess, kind of went up in smoke, right? You gave it to these big banks, and maybe they paid it out in bonuses, and it's gone. Not true. There are also many predictions that, those TARP funds would not be recovered. And the final cost of the government interventions, a lot of people said that's going to run into the trillions of dollars. Trillions. I saw numbers, 4 trillion, 23 trillion. When I think about those numbers and how difficult it was to predict that, I recall the advice of Yogi Berra, who, once said it's difficult to make predictions, especially about the future. So we have a slide here we'd like to show you. And by the way, this is part of a deck that we recently did on the whole crisis that we have copies of. So we dispersed about $420 billion. And this, again, across both the Republican and Democratic administration. Now, that's a huge amount of money, but it's not the full 700. About $245 billion of that was invested in the banking system alone. So on that $245 billion, how much did we get back? Well, we actually got $272 billion. We made a gain. We still got a few investments to get back also. I mentioned earlier that Treasury and the Federal Reserve combined provided $182 billion in commitments to AIG. It was partly under TARP, partly under the Fed authority. What happened to all that? Well, we recovered it all, plus a gain of $23 billion. It is only on the auto investments where we will lose some money, though far less than originally estimated, and far less than it would have cost had we not acted. So if we look at all the disbursements on TARP and all the collections we've made on TARP, plus there are some additional collections on Treasury's investment in AIG, we have now, as of a couple weeks ago, recovered more than has been dispersed. Now, we'll continue to disperse a little bit of money on the housing programs, but we'll also continue to try to get back some investments. And if you look at TARP plus all the other actions we took, because TARP was only part of the rescue, there were a variety of other programs. Most of those are now wound up. There's still a few that are outstanding. But it's pretty clear as of today, if you look at all of those things combined, taxpayers are likely to realize a gain. So I've talked about why TARP was necessary. I've talked about what it did. So what should its legacy be after all this? And particularly if anyone here is at the Clinton School and you're preparing for a career in public service, what should you take away from this as you think about your career? So I believe the most important lesson is that the government acted with overwhelming force and speed to confront the crisis. That was key. The response wasn't perfect. There are no doubt things that could have been done better by the Bush administration, by us in the Obama administration, but I think the government got it right by acting so quickly and on so many fronts and so forcefully to combat the problem. Now, a lot of people say, all right, maybe that's true, but TARP's real legacy is what we call moral hazard, right? Moral hazard means, well, if you went in and you saved some of these companies from failing, then other large firms are going to believe the government will help them out if they get in trouble. And people say, well, you worsened the too big to fail problem that we have. Same thing, essentially, that institutions have now grown too big, we can't let them fail. Those are real issues, but I think that confuses what we had to do to respond to the crisis from what we must do to address the problems revealed by the crisis. Think of it this way. If you're sitting there, maybe sleeping, and all of a sudden you realize your neighbor's house is burning down in the middle of the night, and it's threatening to spread to your house and maybe even the whole neighborhood because he fell asleep smoking in bed. Do you want the fire department to come and put out the fire? Or do you say, no, let's let it burn down because that'll teach everyone not to smoke in bed. Well, to me, that's kind of like where we were, right? TARP was the fire department. You got to call it to put out the fire. You have to deal with that first. If you don't do that, the damage is far, far worse. But there is no question that you then have to look at these problems. Anytime the government saves a private company with tax dollars, we certainly create the risk of moral hazard. And so we've got to deal with the reform now. The crisis made clear that our regulatory system was out of date. We did not have the capacity to identify the risks that were building up in the system, nor did we have the necessary tools to deal with the crisis. And that is why the Obama administration took up financial reform and fought to pass the Dodd-Frank Act and other measures. And we're in the process of implementing those. Now, the reforms being implemented, this is, of course, we could talk for hours about this, but I'll just give you a snapshot. I think the reforms that are being implemented will do a couple of things. One is they'll give us better tools to monitor risk in the system. We were very siloed in the way we approached problems, and regulators didn't talk to one another. So we've got better tools for that. We've got, I think, better tools now to make sure large firms don't take on too much risk. We're going to require them to hold more capital, as well as abide by other prudential standards. And we've got tools, better tools to wind down large firms whose failure could threaten the system. We're going to require the largest financial institution to undergo regular stress tests so we can determine if they can withstand severe economic stress. The reforms will bring more transparency to the derivatives market. Very important market, helps a lot of companies hedge risk, save money, but it was not transparent, and that's where a lot of the problems kind of built up. And the reforms will create stronger safeguards for consumers when it comes to financial products. Now, there is still a lot more work to do to implement these reforms. You know, if you think back to the securities or the Great Depression, which is really a problem in our stock markets, it took years to put in place all of the laws that we put in place after that. But the system is safer and stronger today, but the job is not finished. And I think the other lesson we got to keep in mind is, and the crisis really teaches us this, is the financial system is dynamic. It's constantly changing. It's a source of great innovation. That's a great thing, but as the sources of risk change, our regulation and oversight must keep pace. So a final way to think about the lessons and the legacy of TARP is as a lesson in public service itself. And as I mentioned earlier, the response was carried out over both a Republican and a Democratic administration. My own experience was I joined in the spring of 2009. And I can tell you that for my own involvement, the decisions were made on the basis of what people thought was the right economic strategy. The decisions were not driven by polling data or concern about elections or political calculus. The President, Secretary Geithner, and others focused on what was the right response, and then they focused on how do we deal with the political constraints. And although I was not in government in the fall of 2008, in the Bush administration, I believe the same to be true for the people faced with making the tough decisions then. In a crisis, people do kind of come together. And so I would like to close with some words of Treasury Secretary Geithner in his advice to students of Johns Hopkins as he reflected on the crisis. He said, quote, "You will find lots of people in public life who worry more about how they appear than what they accomplish, who fear the risk in any action, and who let perception and politics get in the way of doing the right thing. If you are going to make a difference, you need to be willing to get close to the flame. You need to be willing to take risk and feel the heat." Now, the courage shown during the crisis wasn't just at the top. There were hundreds of men and women, a lot of them career civil servants, not just at the Treasury Department, but across the federal government, who were involved in the response and who were serving the public during a very difficult time. And they tried to do what they thought was best, and they worked extremely hard under very difficult conditions. And it's really their combined effort that helped the government to succeed. And so as TARP moves into the history books, it's my hope that its greatest legacy will be this: that when the nation was confronted with an extraordinary challenge, in this case, the potential collapse of really our entire modern way of life, modern financial way of life, the government rose to the occasion. And I would hope that if we remember that lesson, for those of you entering public service, I believe you will be better able to make valuable contributions. And for all of us as a nation, if we remember that, maybe we will be better able to confront the great challenges that we face ahead. Thank you very much, and I'll be happy to take any questions.
We have some time for a few questions. Please wait till the microphone gets to you, right here.
You mentioned the necessity of maintaining elasticity or plasticity in...
I'm sorry, maintaining?
Some sort of elasticity or plasticity in financial institutions. As the government is dealing with tightening budgets, do we assume that the role government will play ends up being one of regulation and deregulation to balance those? Because when government spending is cut, we know that the economy tends to shrink.
Sure.
What is the balance there?
Oh, I think it's a very good question. I mean, I think we're obviously in a period where, we do need to look at our long-term fiscal health. Although the thing to remember about this is, our deficits now have fallen enormously since the crisis. So I think you got to separate the budgetary issues from the regulatory issues. We need to modernize the regulatory system. It's clear from the crisis. On the budget side, yeah, I think right now we are suffering because our economy is still not growing as fast, and I think things like the sequester are hurting that. And I think, in my mind, it's a question of looking at short-term versus long-term. In the short term, we're better off if we take actions to get our economy growing, and that means trying to cut the budget more strategically rather than the way we're doing it right now. And that will, I think, put us in a better position to deal with the long-term fiscal challenges, which we do need to deal with. Does that answer your question? Okay. Yeah, right here.
It's coming right at you.
There's a lot of discussion in the media about the current political dialogue about the U.S. government defaulting on its obligations. Now, it seems like sometimes it sounds like they're talking about defaulting on Social Security, but now and then they talk about defaulting on U.S. Treasury obligation, notes, bonds, and bills. Right. And, I think one example of one thing that TARP did is took advantage of the perceived strength of the U.S. government in the financial market, and the idea that that our obligations are perceived to be risk-free.
Absolutely.
Is something that, if it ever goes away, I doubt we'll ever get it back. And that would be a dramatic loss, not only in terms of the interest cost, but also just the power of the government and the financial markets. And my question is it possible that the government would default on interest and principal on our? I mean, even if the debt limit is not increased, doesn't debt come off the top? And isn't at least the Obama administration going to assure that that strength is protected?
Very good question. Let me try to answer it in steps. First of all, is everybody clear on the debt ceiling, right? That's very different from how much should we spend. We can have a debate about how big the budget should be. We can have a debate about what to cut. That's not what the debt ceiling is about. The debt ceiling is about, should we go ahead and pay the bills for the things we've already spent money on or not? So it's kind of like, saying you're not sure if you want to increase the debt ceiling. It's sort of like, you bought the car, you got monthly payments, you get your monthly payment, you open it up and you say, you know what, I think I could save money by not paying this. Well, no, it doesn't work that way. You might have saved money had you not bought the car, but once you bought the car, you got to pay the bills. And if you don't pay the bills, it's going to cost you, right? Because your credit rating is going to go down. Well, that's what the debt ceiling fight is all about. It shouldn't be a fight, right? We've always raised the debt ceiling when we've needed to, routinely. Democratic presidents, Republican presidents, Ronald Reagan did it, It wasn't debated. It's being debated now, and that's very unfortunate. And, that's why the president is saying he won't negotiate over that. Now, he's not saying he won't negotiate over how much money we should spend. He's saying, I won't negotiate over whether America should pay its bills. If we don't pay our bills, we're kind of like a deadbeat nation. So to your specific question then, well, can't we pay the debt, the bonds, Treasury bills, the notes, but maybe not pay the other things? First of all, any failure to pay will be seen by the markets as a default, meaning I believe any failure, whether it is on a Treasury bill or on Social Security payments. I don't think the markets are going to say, oh, well, all they did was they failed to pay all those people who live off their Social Security checks. They're still good on everything else. I don't think that's how the markets are going to read that. And that's not how the credit rating agencies will read that. Plus, mechanically, it's very, it's impossible to prioritize. People say, well, can't you prioritize? Can't you sort of pay the people who really need to get the money and don't pay the other ones? And it doesn't work that way. As money comes in, it gets paid out. It's millions and millions of transactions that are in the system. So I think you have to look at this as, if we fail to raise the debt ceiling and we fail to pay any of our bills, whether it's interest on a Treasury note or whether it's a Social Security check or a veteran's benefit, we are going to damage the financial strength of this country and the credibility of this country, and it's whether people perceive us as the world's greatest superpower for years to come.
I understand that's the administration response, but I don't think that would be the credit response. I think the people that owe credit responsibility think that that's the most important.
I'm sure they do think that's the most important thing. I don't disagree with you, but I think what I'm saying is even if we paid them but we didn't pay other things, they will charge us more. We will have to pay them more in the future to sell our Treasury debt.
Other questions? Frank?
I've got an easy question and a hard question. The easy question is, how much does the government still own of GM, if anything?
Good
and
question.
The hard question is the Fed keeping mortgage rates artificially low, and how much longer can it do that without creating another mortgage bubble?
I'm going to answer the first. I'm not going to answer the second because I don't talk about monetary policy. That is a Fed, that's the province of the Fed, and we at Treasury are very careful about not commenting on that. So I'll get the easy one. We own about 7% of GM stock. We are gradually exiting. We will finish that exit by probably early next year. We are completely out of Chrysler. The only other TARP investments we have left, as I say, we have a few small bank investments, and we have an investment in what was GM's old financing arm called Ally.
Got time for one more question. Anybody have a question? Yes, sir. Right back here at the back.
Do you think the reforms that have been put into place with regard to the banking system are really going to be adequate, or do we have to worry about some other shenanigans in the future?
Sure, very good question. You know, I think the reforms that have been put in place are very, very important because they do give us the tools. Truthfully, you know, until we're faced with other types of challenges and crises, you kind of don't know what you need, right? And as I said earlier, financial system is always changing and innovating. But from where we are today, I think these reforms are very, very dramatic. They're going to change the game. We just have to, you know, we have a lot more work to do to finish implementing them. There was one more question here.
All right, we'll take that one.
Where did the $700 billion come from?
Yeah.
Did you have a windfall that week? And then you talk about investment, and was it loans or investment?
Yeah, okay. So first of all, so the 700 was what Congress said you can invest or spend up to that much, right? So we had the authority to use that much, but we didn't use it all. We're one of the rare government programs that didn't use our entire budget. So by investments, I typically mean both loans and stock equity investments. It was a range. We did mostly what I call equity investments, meaning stock, meaning preferred stock in some cases, common stock in some cases. We made loans in a few cases, so it's a mix. But we've gotten all of it essentially back. The only things, as I say, are outstanding. We went from 400, you know, you can think of it this way. We've spent a total of 420 billion. We never spent that extra, what is it, 280, right? That never got spent. So it's, you know, we didn't use that. Of the 420, about 10 billion was spent to help homeowners stay in their homes. It was assistance to incentivize mortgage lenders to provide modifications. So that's money we never expected to get back. The rest, 410, was in various what I call investments, meaning common stock of GM, preferred stock of 700 banks, loans and stock in our credit market programs, loans in the case of a few small banks, just because of their structure we had to make loans. Of that 410, essentially we've gotten back almost all of it, plus profits, gains on some of it, because we had warrants for more stock, because in some cases we purchased common stock, right? And the value went up, right? You might, you know, if it's like you purchased IBM at $20 a share and then you sold it for 25. Well, we effectively ended up doing that with Citibank and some others. So we made profits on all those, AIG in particular. We still have some investments outstanding, about 20 billion, mostly in the auto industry, and that's what we're still working on getting back.
Let's give Tim Massad a great round of applause. And I know there are more. If you have questions, please come up and visit with him before he leaves. Thank you all for being here tonight. Great program. Great program.